Okay, so if you have messy bank statements, because when you're supplying your bank statements, and let's say you're moving a lot of money, especially if you're moving it from your business to your personal and back and forth, and there's these large deposits that aren't involved in your business, you are going to not slit your wrist, slit my wrist because of all the documentation. And the reason why they do that with bank statements is more about money laundering and fighting terrorism. And so they will put you through your paces on your bank statements. Now, if you don't want to be put on your bank statement through your paces on your bank statements, um, because of messy bank statements, the asset qualifiers, and this is liquid assets that you're not moving a lot of money in and out of some of those more illiquid assets. So we go with this loan program, the asset qualifier. These are the people who qualify. Again, pretty much the same. Not
Some do allow foreign national and I-10 on these. It's just got to be a specific lender, but for the most part, it's your typical.
right. Right. Yes. We again, as brokers, we usually can go out and find the loan that's going to fit the client, the borrower, the family.
Yep,
Yeah, this more of a general rule, not hard and fast, more of a guideline.
there you go.
Okay, so how do you qualify assets which are liquid or may be liquidated without restriction? What specifically am I talking about? Here's some of the asset types that you can use. Um, so, and Bitcoin, I mean, Bitcoin became more of a player, what would we say, 5 years ago, 6 years ago?
Yeah, literally, I think that was 2020 when, everybody was doing the crypto thing and then people came out with guidelines about not allowing crypto. But yeah, absolutely.
Yeah, so if you think that you don't have a clean bank statement, this would be the option for you. And then it's just a matter of making sure you have those funds. I'll put the equation in there in a second, but for those who don't know what seasoned 60 days means, just means when you pull out that money from Bitcoin, you have it sitting somewhere for at least 60 days in a bank account that we can document.
Yeah.
And so the calculation methods, there's three of them. If you want to kind of give a gloss over on what these are, what they're talking about here.
Yeah, so total post assets must equal 125% of the mortgage debt. So for example, if you're buying a mortgage, if you're getting a mortgage for 100,000, you should have normally about $125,000 in assets. Total post closing assets must equal 110% of the subject loan amount plus 25% for all the other outstanding mortgage. Same thing, $100,000 mortgage, you should have about $110,000 in assets, plus on top of that 25% for all of your other outstanding debt. Maybe you have more investment properties or car loans. And then the third is the traditional, which is 100% of the loan amount with reserve requirements. So buying a $100,000 property, you should have $100,000 in reserves. Plus, usually the banks will normally make you have 3, 6, 9, 12 months of reserve. What is reserve? It just means that it's the amount of your mortgage payment times 3, 6, 9, or 12 months. So if the mortgage payment is going to be $1,000, the bank wants you to show that you have $3,000 or $6,000 or $9,000 or $12,000 sitting somewhere. And so again, kind of like what BA is saying, we can help out so many people. There's so many ways to do it. And what BA said also is that it's the 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 money has to be money that can be liquidated at some point in time. For instance, there's I know there's like teacher funds and stuff like that, but usually those can't be touched until a certain time, so we wouldn't be able to use those. It would have to be funds that would be able to be liquidated.
Well said. Well said. Here's some of the other features on the asset qualifier. Credit score is a little bit higher. I love that there's no DTI restrictions, but then that's again another conversation you have because we want to set people up to succeed, not fail. And some non-warrantable condos, and usually what that means, I guess I should talk warrantable, non-warrantable. We're using words that we use every day, but a lot of people don't understand. So condos don't get a lot of love because They're based off of resale value, and especially after 2007, 2008, there were a lot of people speculating, amateur investors buying condos before ground is even broken, and before the crash, like they could buy, and then by the time the project was completed, they could have $50,000, $100,000, and they would just sell it. But then when the market turned, all of a sudden you have all these condos sitting empty, and people were just walking away because it wasn't their primary residence. So you want to have condos occupied. If they're not occupied, that's a problem. If they're occupied by more investors than there are residents, that's a problem. They want, usually Fannie or Freddie wants them to be at least 51% owner occupied, because renters don't take care of the property as much. Or they want it phased. They want it to be, at least, like, let's say you have uh, 40 condos. They want 36 of them to be completed in the phase. So there's all these things about warrantability. Then when the place fell down in Miami because of deferred maintenance, then they got even more strict on condos. So some of these things I just talked about, now you may have one of those for non-warrantable. Maybe it wasn't warrantable because you had 50% owner occupied versus investor. They may give you an exception on that, but if it's like 51% and then not all the phases are completed, so that's not gonna work. Or if they're deferred maintenance, the money in their deferred maintenance, that might be an issue. Or another issue is if there's a litigation. So on the non-warrantable condos, you might get away with one issue, but not more than one. So that was a quick skinny on the non-warrantable condos.
The
Uh,
other The other thing that we didn't touch base on quickly was the asset qualifier, is that we do have some lenders who will take your assets and divide it, like you said before, divide it by 5 years, and they'll use that as your monthly qualifying income, which is super nice because if you have $600,000 in assets and you divide that by 5 years, you're coming up with a decent amount of income. So
absolutely.
that's a
So yeah, don't. If overall, I would say, just if you're thinking about buying investment properties, just let's have the conversation, because there's usually a solution.
yeah, absolutely.